If you have money in the stock market right now, you're standing directly in the splash zone. The exact metric that tracked the buildup to the dot-com collapse and the 2008 financial crisis is currently flashing a 230% reading. And while the retail public throws their paychecks into a euphoric market, Warren Buffett is quietly taking cover. Navigating this degree of market overvaluation requires a different strategy than the one used during the bull runs of the last decade. You've likely been diligently pouring your savings into a 401k or brokerage account. With AI stocks surging and tech companies dominating the headlines, it feels like this rally will never stop. But the math tells a very different story. Right now, the entire United States stock market is priced at more than double the size of the actual underlying U.S. economy. This massive disconnect between asset prices and actual economic output means the current wealth boom is built on a foundation that history shows is highly unstable. To understand why that matters, let's look at this diagram illustrating the Warren Buffett Indicator. It takes the total value of the U.S. stock market and divides it by the country's gross domestic product, the GDP. Think of the real economy as a hand and the stock market as a rubber band. Historically, when the indicator sits between 80 and 100%, the market is fairly valued. You can see the rubber band is relaxed. But as the market stretches past 120% and approaches 200%, the tension gets extremely dangerous. In 1999, everyone thought internet companies would climb forever. The indicator stretched to 140%. Then the dot-com bubble collapsed, wiping out trillions of dollars. A few years later, Wall Street was entirely confident the housing system was stable. Valuations remained highly elevated right before the 2007 financial crisis tore through the global economy. Now look at this chart tracking the indicator today. We have the 1999 peak at 140% and the 2008 peak around 110%. Today, the line violently breaks through the ceiling, sitting at a staggering 230%. Bubbles do not feel dangerous while you are inside them. They feel exciting. People ignore the math due to a massive fear of missing out, watching their neighbors get rich and assuming the upward line is a permanent fixture. Markets do not collapse when the public is terrified. They collapse exactly when the public becomes absolutely convinced that a crash is mathematically impossible. While retail investors and social media personalities scream to buy everything in sight, Warren Buffett has been systematically selling off his stock positions. Berkshire Hathaway is currently hoarding the largest cash pile in the history of the company, hundreds of billions of dollars sitting completely idle. He operates on a ruthless principle: price matters. Even a highly profitable, perfectly run business becomes a destructive investment if you pay too much for it up front. When valuations hit these extremes, large-scale capital often begins a quiet migration toward the exits, leaving the retail public vulnerable to the eventual correction. Significant institutional capital is now sitting ready to acquire assets at lower valuations, waiting for the entry point that a major market downturn provides. The Buffett Indicator measures long-term valuation rather than immediate timing. Historically, buying into the market at these levels has correlated with significantly weaker annualized returns over the following decade. Surviving this environment does not mean liquidating your retirement account in a blind panic. It means setting up a defensive structure right now so you can buy the bottom later. Step 1. Audit your risk and rebalance. Trim your exposure to unprofitable, high-hype tech stocks that will suffer the most in a severe downturn. Step 2. Build a cash war chest. Holding capital on the sidelines gives you optionality to act aggressively when the market finally goes on sale. Step 3. Target quality companies at reasonable prices. Stick to consistent investing habits, but strictly focus on businesses with real cash flow and defensible margins. The most destructive mistakes in financial history happen the exact moment investors decide that historical metrics no longer apply, and that this time is different. Preparation will always beat panic. Let me know in the comments if we're in a massive bubble, or if AI growth actually justifies these prices. If you want to keep tracking the smart money, hit subscribe and click the video on your screen to see which market sectors are currently hiding the most risk. See you in the next one.